Okay, so by far, the most asked question that I get on every single one of the videos that I post on YouTube is, what stocks should I invest in? Maybe you're a brand new investor, you're just coming to this channel for the first time, and if so, my name is Dalton and you're on DLITS TV. On this channel, I talk about all things investing with my tips, tricks, and insight into the stock market. So if that's something that interests you, you're looking to increase the size of your portfolio, quickly jump down, click on that subscribe button, turn on the bell notification, because I post a ton of content you're definitely not gonna wanna miss. And in this video today, I'm gonna be looking into that very question. What stocks should you invest in when you just start out investing? And that's a little bit misleading because actually, if you just start investing, I really think there is a better way that you can go about it, one that is proven to work, and statistically, you're gonna do better in the stock market if you invest in this way. So if you're wondering what it is, just make sure you stick around and hear me out, because this video is the one you've been waiting for. Now, the first thing I really need to stress to you guys is that I am not a financial advisor, so I can't actually tell you where to put your money. That would be illegal, and I'm not trying to get in trouble with the law here. I'm just saying that I need to be careful with what I say, so I can't necessarily make any recommendations. I can't tell you specifically what you should or should not be investing in. All I can do is talk about theoretically what I would do in these situations. And here's the thing, I am a very long-term oriented dividend investor. So what I like to see for returns may be a little bit different from you. I like having a stable portfolio, a steady income from dividends that I can reinvest into my portfolio. I think it's a really solid way to go about investing, and you're gonna see some solid results from it as long as you're investing for the long term. But there are other methods to the madness. You can do things like you can trade stocks. Trading and investing are completely different things. If you're trading stocks, you're not necessarily holding onto it for the long term. You're trying to, in a way, figure out what's going on, play momentum, and just trade stocks as it sounds. So I'm not into any of that stuff. I don't think about buying a stock on Monday, selling it on Friday. What I like to do is set it and forget it. If I'm investing, that's exactly what I want to be doing. I want to put my money into the market, and I don't want to have to think about it any more than that. So that's the way that I try and structure my portfolio. You're not really going to find these trades here on this channel. You're not going to find the hot stock, the penny stock you should be investing in. I don't do any of that. I don't even waste my time looking at those stocks. But here's something that I actually do. When it comes to investing, you can pretty much find some really solid investments just by looking around at different mutual funds. Okay, there's some really great mutual funds out there that are going to give you around a 10% return annually on the stock market. They're proven. I'd probably look at the past 5 years, see where they're at, and try and pick from that. But I invest here on Robinhood, and on Robinhood, you can't actually buy these mutual funds, but you can buy ETFs. So here's a list of some of the ETFs that I would consider if I were brand new on Robinhood, just getting started out. All right, so bear with me. This first list is comprised of multiple ETFs that focus on dividend income. So on this list, we have SCHD, VIG, HDV, SPHD, and VYM. If you don't know what an ETF is or how they work, essentially you can think of it as a basket of stocks that is comprised and all wrapped up under one neat, tidy bow. So if you invest in one of these, you're theoretically getting a piece of many different investments. So in that case, if one of these were to drop in value, you can pretty much hope that the rest of the portfolio is going to be doing relatively okay. If one of them completely tanks, you're still going to be steady. You're not going to lose as much money as if you were only invested into one particular stock. Now that's where you get the quote, don't put all your eggs in one basket. That's exactly why ETFs were created, and it helps you diversify. So there's one thing that you want to pay attention to when you're investing into ETFs, and that's going to be the expense ratio. So a lot of people are concerned that, SPHD is my favorite on the list. And the reason why SPHD is my favorite is because they are a high dividend paying, but low volatility stock. So if the stock market goes up a ton in value, it's going to go up in value, but it's not going to rise as far as the market goes up. However, if the stock market were to tank, then that's where SPHD comes into play. Theoretically, it should not tank as low or as fast as the market drops. So that just allows me to leave my money in there, feel a little bit more confident. And the other thing I love about SPHD is it pays you monthly dividends. So as you're holding on to it, you're just being paid out every single month. And it helps me leave my money there, feel more confident as an investor. And basically what I do is just reinvest dividends back into the ETF. So it's pretty solid. But one thing that SPHD has is a high expense ratio, or relatively high comparatively speaking. Now that is an expense ratio of 0.3%. And I know what you're thinking, if you are familiar with them, you're gonna realize that is relatively high. But the thing is, to me, I look at that number. I don't have a ton of money invested into the stock market right now. I have around $10,000 in my Robinhood portfolio. And the way that I look at that is, if I were to have $100,000 invested and I put that all into SPHD, basically you have to pay in order to use ETFs services. So because they are, monitored, if something happens and the stocks are kind of adjusted, you may lose some stocks from an ETF. New ones might be added to replace those old ones. There's a little bit of maintenance that goes into it, and you need to pay to be able to use something like that. It allows you to be hands off, and you can get some results passively from doing something like that. Now, the expense ratio of 0.3%, I look at that and I say, if I had $100,000 into SPHD, I'm only paying $300 a year for that service. And to me, doesn't really matter, that $300, if you have numerous hundreds of thousands of dollars to invest, that's when it starts to add up. Those extra $100 that you get every single year really will start to affect the growth of your portfolio. But in my case, it's really not making that big of a difference right now. But wait, Dalton, let's take a step back. What is a dividend? How does it actually work? Well, if you look at the dividend yield on any one of these ETFs, you're going to realize that that is essentially the value that you're going to be paid out. So let's say one of these ETFs was listed at a 5% dividend yield. It's a relatively high dividend yield, pretty nice if you're receiving that. But here's the thing, when you invest, let's say $100, make numbers nice and round, nice and easy to work with. If I were to put $100 in to that ETF and I'm expecting to get a 5% dividend, what that actually means is that at the end of the year, all of the dividends that have been paid to me should equate to $5. So if it was a 4.5% dividend yield, then I would get $4.50. Now that's not every single time you're paid. That is every single time the ETF pays you a dividend. So if it's a monthly dividend paying ETF, then it's going to be that $5 or that $4.50 mark divided by 12. And that's going to be your payment every single month. Now, on the opposite side of this spectrum, you might want to invest a little bit more risky and look to get a higher reward out of it. Well, there's one way that you can do that and still be diversified and still have a pretty solid portfolio if you're just starting out, and that's investing in total stock market indexes, something that traces the overall actions of the stock market, because year over year, you're looking at around 8, 10, 12% return from the stock market, and that number is pretty solid. So the ones that I myself look at would be VOO, SPY, VTI. There's a number of really solid ones that you can really put your money into and not have to think all that much about. But here's the thing, you need to realize they're just a little bit more volatile than other forms of investing. So if you were to invest now, where we're at all-time highs in the stock market, if it were to dip, 10%, let's say you put $100 in, now you're down to $90, you need to realize that this is kind of expected with more of these volatile stocks. You need to be able to have a hard hat on, you need to be able to have a backbone and not worry too much about your investments. And if you're making these really risky investments in stocks and they start to dip and you're panicking, honestly, if you haven't done the research, you haven't put in the proper amount of time and energy that goes into it, then you could end up in a huge hole. You could hold on too long, you could sell too quick, the stock could bounce back. It's really hard to follow along with that. And at the end of the day, it's extremely hard to time the market. So no matter what strategy that you end up using, no matter if you feel like long-term dividend investing is the way for you to go, or you want to invest in some of these other ETFs when you're just starting out, you just need to remain consistent. Keep putting money in. If the market's at all-time highs today and it starts dropping tomorrow, I'm just going to put more money in because it's going to drive my costs down. That way, when the stock market bounces back, these particular ETFs go back up in value. What I'm looking at is a nice solid return because I've been pretty much dollar cost averaging my way in the entire time. So a lot of people ask me on pretty much all my videos, like I mentioned, what stocks should I invest in? Is this stock good? Is this stock good? If you're trying to make a momentum play, if you're trying to do an options trade right before a company announces earnings with no basis whatsoever, I wouldn't say that you're investing. I wouldn't say that you're trading. I would probably say that you're gambling, and you need to think twice about this method. And I'm not saying that, to be a jerk. I'm not saying that just to like push you guys off, stop commenting, things like that. But the reason why I say that is because I was there too. I made the same exact mistakes and learned from it a little bit quicker than a lot of people. So when I first started dabbling with options, I started trading Square. Square was really, really low in value when I started doing this. And I realized, had I just put all my money into Square and held, or had I not traded options, been a little bit more, the thing at the end of the day was I really believed in Square as a company, and looking at them now, they have very, very much surpassed where the value was where I would have invested in them. I probably would have doubled, tripled my money at this point in time. And so that really was one of the main things that opened my eyes to investing. That, and I lost around $1,500 very early on an option trade when my portfolio value was $1,500. So it puts a lot into perspective as you start losing more money, and it puts a lot more in perspective as you start making it back. How you actually do it, if you can climb yourself out of that hole you created, which I've successfully done, it just makes you feel so much better. So yes, like I said, a lot of people ask me these questions, and this is exactly how I would invest my money if I were just starting out funding an account. You'll notice that a lot of the different combinations of holdings that I'm going to have is going to start dwindling. I'm going to start practicing what I preach and investing more in these particular ETFs. Now, again, I'm not saying I'm some stock market guru. I'm saying quite the opposite. And I think everybody is at one point in time intimidated by the stock market. And I'm trying to break down that barrier, make more people interested, and just realize that the stock market isn't a game, and it is actually calculated, and there's a way that you can beat the market. And in my case, investing in ETFs, being broad, but investing for the long term is the best way that you can grow your money. So with that being said, if you took any value away from this video, I would really appreciate it if you just click that like button. It helps get this video out, puts it on other people's pages, and really it just shares my account with the world. What I really would like to do is grow my YouTube channel. And this is one of the ways that I've been making passive income recently, and I'm just trying to share a bunch of different strategies around that. So again, thank you so much for checking out this video, guys, and I hope you have a great day.